Good afternoon, everybody, and welcome to everybody tuning in on the live feed this afternoon. Well, it's finally here at last. An incredible amount of speculation around this budget, and the media in particular. The drama surrounding it has been something similar to the last series of Bridgerton in the way that it's going. So, but from your point of view, at least now, after the 16 weeks that we've been through, we can actually start to give you some clarity. So just to run through the agenda for this afternoon, we're going to change things around slightly. So I'd like to, Luke Pearce from Rowan Dartington, who's the stockbroker arm of St James's Place, is going to start first, and he's going to give us a review of the markets and go through the main points of what we feel are likely to be going to affect the markets going forward. Luke will then actually take questions at that point because he's got to shoot off. So we can take some questions on that at the end of that. And then Richard will then sort of go through the main budget itself. And then there'll be some general topics that we'll be covering, and then we'll be able to take some further questions at the end of that. Before we start, if we're going to ask you to fill in your feedback sheets and hand them in at the back before you go. But I hope you enjoy this afternoon and find it useful. And I'll now pass over to Richard and we'll get started. Thank you.
Hello, everyone. I've got these notes here, but I haven't actually written down anything on them. There's nothing there. What I was going to do was to have a little chat with you about what's been happening on the markets, what's been influencing things, and what might influence things going forwards. So just to start off, it's sort of trying to paint a picture and a little bit of a journey. So a bit like investing, it's not what happens today, it's about what happens tomorrow in a few years' time. So as we look back to the start of this year, we came into the year with markets having performed quite well. The index that I put up here, it's MSCI ACWI. ACWI stands for All Country World Index. So in simple terms, it's the global stock market. And over the past 5 years, it's performed very, very well. It's up 75%. So it's been very pleasing. And that includes the rather large and ominous dip in there, which was COVID. So the past 5 years have been a good year for investing. What happened last year? Actually, we saw inflation falling back. So we had a lot of nerves as we came into the start of this year, but we were quietly optimistic. Inflation had fallen back. We got rid of the supply disruption. Some of that excess cash had been burnt off. Inflation was falling back. Hadn't yet hit central bank targets. We're now pretty much at those central bank targets. So it's been very pleasing. So for those of you who turned up here in March or wanted to know our views from March, there were pretty much 6 sort of factors that were influencing things. So as I said, inflation, but that was less of an aspect that had already been, largely speaking, beaten. Interest rates were very much at the forefront of people's minds. So it was, are they going to be cut? How much are those going to be cut by? And we've started that cutting process. I'll elaborate a little bit more on that in a second. There were the fears of recession. So we'd had these very sharp increases in interest rates, and we knew that central banks were trying to tighten things up. The question was, were they going to over-tighten? Was that going to cause a recession? There's AI. There's still AI. I'll chat about that in a second. Politics. Still got a little bit more of that to come. China and Japan. But from an economic perspective, we came into this year thinking about a Goldilocks scenario. Now, that's one of those technical terms. It doesn't really mean much unless you're in the finance industry. But you could put it another way as a soft landing. So it's when inflation is falling, interest rates are falling. Economic growth, it's not particularly exciting, but it's fine. And that tends to be a very good environment to be investing in. So it can be one that is volatile, but it tends to be a good environment for investing in. And largely speaking, that's what we've experienced this year. So this is MSCI World year to date. And broadly speaking, it's been a good year for equity markets. Now you can see on there that there were two significant blips. So one at the start of August and one at the start of September. And I thought it would be useful to just try and bring those to a little bit of light. So everyone's happy when markets are going up. It's what happens with those little blips and what caused them. And really those bits coincided with the cutting of interest rates. So the Federal Reserve, the Central Bank of America, cut interest rates, and they did so by 50 basis points, or 0.5% in plain English. People got concerned about why they had cut to such a degree. Was that the sign of a recession coming? And this chart that I've got behind me, you can see a black vertical dotted line. That is that's effectively day one of when central banks cut interest rates. And the argument is that there are two possible courses of action once central banks cut interest rates. One, they're cutting too late, and that causes a recession is just around the corner. And that results in the red line that you can see down at the bottom, i.e. equity markets perform quite badly. That's what investors were concerned about back in August and September. The reality has been different. So the green line on there is when central banks have cut in a timely manner. So they've got rid of inflation. They've got inflation back to the levels that they want. Economic growth has been fine, and equity markets can perform quite well. And that's the green line. And broadly speaking, we followed that green line since that interest rate cut. So it has been a good environment for equities, and they've continued to perform well. Now, I can get a little bit down in the mouth about central banks. There's lots of reasons to criticize them. But the reality is that whilst they did increase interest rates very, very quickly, the recession probabilities have fallen. So economic growth around the world, particularly in America, has remained very resilient. So the recession probabilities have fallen, and in fact, jobs growth has remained remarkably robust. Now, some of you may have seen the jobs figures that came out today from an American perspective. Depends on how on the ball you were. They came out about 20 minutes ago. They weren't particularly strong. That being said, those jobs data have totally been messed up by two hurricanes that happened in America. So ignore the jobs data that came out today. The jobs situation in America is looking pretty robust. So it's been a good economic position. Central banks have so far achieved what they wanted to do. So as we look around the world, what's been going well, what hasn't been, what's happening? My first bit is, this is a quote from myself. And the reason for putting up a quote from myself is that I forget all of the ones from famous people or I misquote them, and that's not very good. But I think it's fair to say that the future is uncertain. So we could look at stock markets, we could look at the political situation around the world, we could look at the geopolitical situation around the world. There is a lot of uncertainty out there. Whenever there is uncertainty, you don't want to pay too much for it. So if you don't know what's going to happen in the future, don't pay too much for those future earnings or that future potential price. When we look at stock markets around the world, we need to be conscious of that. So this table up here is showing various stock markets around the world. The column on the left-hand side is showing America. Now, the red diamond that is on there is the current position. Now, what you can see from this chart, and it goes back to, I haven't put it on there. It's over, I think, the past 20 years. What you can do is you can see on there that the American market has always been more expensive than other markets. What you can also see is that it is more expensive than arguably it ever has been. And yes, the American market is expensive. So we need to be conscious of those valuations and whether we are paying too much. As you move from the left to the right, you can come across and you ultimately end up with the UK and China. I will come back to both of them in a second because I think it's quite interesting. There is value in both of those markets at the moment, but we need to be very conscious of valuations when we're choosing investments and constructing portfolios. So if we look at America, if we go back to last year, And we have a recency bias. So we all tend to want to buy things that have been doing well. It's totally different from going shopping, where we want to go and buy things when they're in a sale. When we're investing, we want to buy things that are going up in value. If we look back to last year, the red line on here is the NASDAQ, so it's technology stocks. And last year, investment, and the black line on there is the S&P 500, so the largest American companies. You can see very much that returns were very much skewed towards technology companies. It was the era of the Magnificent Seven, so your Amazons, your Apples, your Microsofts, your Nvidias, did very, very well. The broader market didn't do as well. So as we came into this year, everyone was clamoring at us, we want to own tech, we want to own tech. The reality this year has been very different. We've seen a much wider broadening out of market returns. It hasn't been so consolidated in those technology companies. And in fact, the S&P has been performing a little bit better than the NASDAQ year to date. So that's been good. I could elaborate further and we could chat about interest rates and inflation and things, but that's been the nub of things. The other side of things that we need to be conscious of from a recessionary perspective is there is an old adage which is don't fight the Fed. So when the Federal Reserve are raising interest rates, tightening things up, you don't want to get too enthusiastic about things. But Jerome Powell, who is the chairman of the Federal Reserve, turned around and said, if the American economy suffers a slowdown, we will cut interest rates. He's got your back as investors, and that's very positive, and investors have very much taken him at his word on that side of things. So yes, valuations are rich, but yes, central banks are there, ideally to provide support to economies should the need arise. Now, there is the question of AI. I don't know that much about AI. So I think it could be transformational. I know that technology in general has proved transformational throughout all of our lives. One of the concerns that we have is, are people paying too much for technology? So we've had most of the Magnificent Seven now, with the exception of Nvidia, coming out with results. The big tech companies have spent $200 billion over the past year on investments, so investments into AI, technology, et cetera, et cetera. So 42% increase on what they spent last year. So they are spending a lot of money. The question that we as investors have, or investors in technology must have, is, are they getting bang for their buck? It's all very well putting money into tech, making investments, but you need to get a return from it. And that's something that we need to keep a very watchful eye on when we look forwards. Now, from a tech side of things, semiconductors seem to get everyone very excited. Semiconductors are the chips inside most of the tools that will power AI. There are two global leaders when it comes to chip manufacturing. One is ASML and the other one is TSMC. TSMC standing for Taiwan Semiconductor Manufacturing Company. I'm only going to say TSMC going forwards. What you can see is that the chart showing their share prices take very different directions. So TSMC make 90% of all of the AI chips. Its share price has been doing very well. ASML has been doing very badly. So you've got to have diversification within your portfolios. I've chosen one example. We could have chosen America. We could have chosen anything. So it's important to have diversified portfolios. Now, one other region in the world is China. It's one that causes lots of emotional feelings. China arguably gave us COVID. It is a socialist state. It gets lots of people very excited. It's also had a lot of economic issues facing it. So if we look at the share price of the Hang Seng, so the Hong Kong index, which in simple terms is the best way or the most common way for Western investors to invest into China. You can see it is the black line at the bottom, and the red line is the S&P in America. America has been doing very well. China has been doing very badly. Why has China been doing badly? They had COVID much worse than us. It lasted for much longer. They didn't give the free handouts, and they didn't have the economic bounce once lockdowns ended. They had a property crisis and they had a banking crisis, all of which has very much caused an economic slowdown to happen. And that's been reflected in the Chinese stock market. up until about a month ago when they announced a huge stimulus package. I'm not going to go into the details behind it, but in simple terms, it resulted in a massive re-rating of the Hong Kong market. So the Hong Kong market, which had been massively underperforming, in fact, year to date, is outperforming the S&P. So it's showing what happens when something is very unloved, very underowned, very oversold. You can see a massive re-rating that happens in share prices when there is some positive news that comes on the back of it. Another reason for diversification. Now, talking of unloved markets, we have the UK. Now, Rich is going to chat in much more detail in a second about the budget and from your personal influence side of things. But from a market perspective, the red line that's showing on this chart is MSCI World again, so the rest of the world. The black and grey lines on here are the FTSE 100 and the FTSE 250, so the UK domestic markets. You can see that over the past 5 years, we've very much underperformed the global stock markets. It hasn't been an environment where productivity has been particularly exciting, and that's been reflected in the UK market. Now, in fact, over the past year, things have changed a little bit. So we've seen a re-rating from the FTSE 250, which is the smaller companies, more domestically orientated. We've seen a large number of takeovers because they have been cheap. And also the anticipation of lower interest rates means that smaller companies should perform better. So we've seen the FTSE 250 performing okay. Now, you're going to hear a lot more about the budget from Richard in a second. But from a market perspective, I think the big question that I had prior to the budget, and which I don't have, but the question I had before the budget was, is the budget going to be a catalyst of change? Are we going to get a whole load of measures that are going to result in a meaningful re-rating of the UK markets? Is it going to invest that growth that people voted for? I think I would have to say it hasn't done, or it hasn't done yet. I don't know whether it will. I don't think it will. But we have seen gilt yields increasing. So there has been a lack of confidence from a bond market perspective. We saw a little bit of a relief rally in the AIM markets in some smaller companies. Some of that has faded a little bit. So this hasn't been the catalyst that we were hoping for. That may still come. Brit ISA has been put on hold. There's been limited news towards sovereign funds. What we have seen is that we are going to be operating in a more state-run economy. So there is going to be a greater proportion of spending that is going to happen from the government rather than by private or capital-orientated industries. Is that going to result in a significant productivity increase? I'm going to leave that one open to you. I'm from a capitalist mentality, and I question that. I have to hope that Labour knows more than I do, and hope that that is going to result in significant improvements in our economy. From a market perspective, so far it hasn't had a bearing. Now, when you're thinking about that from your perspective, Rich is going to talk about your personal aspects in a second. From a market perspective, the UK markets do not represent a significant proportion of your portfolios. Arguably, it should represent a much larger proportion than it does, because in other countries around the world, they are encouraged to invest in their domestic markets much more than we are. I hope that that might have been a catalyst that could have been introduced, but it didn't happen in this budget. But from an MSCI World perspective, the UK market is about 3.5–4% of the global markets. One needs to be much more conscious about what's happening around the world than being solely focused on what's happening in the UK. Now, there are other aspects that are happening. So what else has been influencing conversations, our minds, and things like that? Firstly, the Middle East. Now, from a humanitarian perspective, I have considerable concerns towards what is happening in the Middle East. From a financial perspective, from a market perspective, it has so far had very little bearing. So the most obvious aspect that would change through increased tensions in the Middle East would be the oil price. Now, I have purposely chosen the 7th of October for all logical reasons. The oil price is down over the past year to October, so it's down somewhere around 10%. So far, despite the increase in tensions in the Middle East, it hasn't escalated and it hasn't had an influence on the oil price. So far from a financial markets perspective, it hasn't had a bearing on things. One of the other things that is hugely topical at the moment is what's going to happen next Tuesday, Wednesday with the American election. Firstly, it will be too close to call at the moment. So fine, there are betting markets out there that will turn around and say Trump's going to win. I would personally take them with a slight pinch of salt. Roughly speaking, about 45% of the American population is Democrat and 45% is Republican. It is a 10% swing vote that is all that matters. Rich is going to elaborate a little bit more and narrow it down to an even finer amount than that, which is right. But I think it's going to be interesting to see what happens. So roughly speaking, both parties have made commitments to increase spending over the course of the next parliamentary term. Trump arguably by a larger amount. He has also talked more about introducing tariffs and protectionism from an American perspective. The general consensus is that either party is likely to result in greater inflation. I think Trump is likely to result in even higher inflation than Kamala Harris will, which is being reflected in bond markets. So we're seeing that from a UK perspective, we're seeing that from an American perspective. So I think it's unlikely that we will get as many interest rate cuts as people might have wanted or hoped to have happen as a result of the election. From an interest rate perspective, yes, it has a bearing here in the UK. Yes, it has a bearing in America, and lots of people get very excited about the American debt levels. If I wanted to give you a tip, I would keep an eye on what's happening in France. So France is the country that arguably is in the most difficult position. So it's running a very large deficit. It would like to devalue its currency. It can't because it's in the euro. If interest rates remain very high, France is the one that is probably in the biggest position, in the worst position. So keep an eye on that one over the course of the next year. But from an election perspective, I think that this chart is probably quite useful. So it goes back to 1960. You can see the Republicans and the Democrats in their various colours going back to 1960. There is a general trend upwards. It doesn't really matter whether it is red or blue. On the whole, the markets have been uninfluenced by which party has been in control. I think that that is an easier way of looking at it. Now, I mentioned a second ago about the increased amount of spending that is happening in America, the increased amount of spending that is happening from a UK perspective. That is one of the reasons why the gold price has been performing so well. We have seen a huge amount of central bank buying of gold, particularly Asian central banks. Some of that has been down to concerns towards currencies. Some of that has been concerns towards levels of debt. Some of that has been down to concerns towards geopolitical aspects, so whether that's what's happening in the Middle East, Russia, Taiwan, China, etc. But the gold price has been performing very, very well from that side. Just in summary, I think it is a time of being cautious. So we need to keep an eye on inflation is at the moment where we want it to be. It's where central banks want it to be. I think the risks are potentially that inflation will rear its head again. Hopefully not to the same levels that we experienced a couple of years ago, but I think the idea of going back to the pre-pandemic inflation levels is highly unlikely to happen. Economic growth at the moment is fine. As I said a second ago, I get slightly concerned towards the rate that central banks increased interest rates. So far, that economic growth has been fine, so I can be conscious of it. From a market side of things, it's been okay. Central banks have got your backs, so they will cut rates if they need to. Geopolitical aspects are going to remain at the forefront of things, and the press are going to fuel that. So if we think back just to our own situations, really, there is a difference between what people think that they deserve, what people want, and what they can actually afford. So if we go back to post-COVID, Inflation came about and people got awfully upset that they couldn't afford to go on 3 holidays a year. They've consequently voted with their feet, or voted with their pens, for a change, and we now have an environment that will be more state-orientated and state-controlled. We have to hope that that is going to result in a better picture, improved health service, improved train lines, etc., as we look forwards from here. So I think from our side of things, we're very much looking at the growth side of things, and it's very, very important to be diversified within portfolios. That is it from my side of things. I am very happy to answer any questions if anyone has any, on pretty much anything. Don't ask me about the budget, because otherwise Richard's going to come straight up here. But if you've got a question on markets, the economy, gilts, nothing. Oh! I will leave you to it, Richard.
Right.
Thank you all very much indeed.
Thank you very much, Luke. Luke's going to disappear. He's got another commitment later on. So thank you very much, Luke. And everyone's saving up their questions for John and I. Right, let's move on. So, the budget. My winners list. Yes, there were some winners from the budget, you can argue. 16 to 18-year-olds have got a 16% increase in the minimum wage. They're now paid £10, and the living wage has gone up by 6%. We're not taxed more on fuel, so drivers are fine. John and I can drink a pint and pay 1p less a pint or something like that. And high street retailers have had their business rates relief extended. So there are some glimmers of joy. Trouble is the losers possibly are a slightly longer list. So if you've got a defined contribution pension pot, already talked to someone here today, liable for over £200,000 more inheritance tax as a result of a budget than before. And we'll talk about that later. Employers are going to pay an extra 1.2% national insurance, and the threshold's dropped. So a £35,000 worker for an employer still gets the same wages, but it costs 26% more for the employer to continue to employ that person. You as investors, if you're outside of the ISA in a taxable portfolio, or you own shares that you've inherited and have for long periods of time, are going to lose out because you pay more capital gains tax. I think particularly controversially, farmers and business owners who have their wealth in fixed assets and not liquid areas are, once they reach £1 million in that asset, going to pay from April 26 inheritance tax at 50% that rate, which is in a way directly opposite what they said the Labour government or Labour opposition party said at a number of events last year. Landlords, so if you obviously rent or have second properties, you're going to pay more stamp duty when you buy them, 5% surcharge from before, and clearly the capital gains tax issues and paying in 60 days, and the rights of the tenant have got stronger. And if your grandchildren are at a private school from January, well flagged, it's going to cost 20% more. And it doesn't stop there. I've added at the very bottom vapors. So my two of my 3 children, quite rightly, they're the losers, I'm the winners, are going to pay some tax on vaping for the first time ever in a couple of years. Horrible habit, and I'm delighted to hear it. Also, any of you who have a private jet and are hopping on your private jet to go from the UK to California, the air passenger duty on your private jet has gone up by 50%, and that alone will apparently cost you £450. So they're the losers too. Okay, so what's the broad thesis behind this? It's quite simple. It's tax, and it is spend, and it is borrow. It is almost going back to the 70s when Labour were last in this form of power, maybe not so much a Brown and Blair lanes. 40 billion pounds extra in taxes, most of that on businesses, Increased expenditure by far more, 70 billion front-end loaded in the next couple of years, and a large portion of that obviously is borrowed. And so you've got the UK ending up having its highest post-war ever tax burden by the end of the current Parliament in something like 38p. We have gone back big state. And I'm going to give you a couple of quotes, one from EFT, a very esteemed journalist, Martin Wolf, and he said, "The budget marks the burial of Thatcherism. It also heralds a permanently bigger state. Increased taxation, increased borrowing, and increased spending are more synonymous with a decidedly old Labour government. It is clear that the Labour government have a dire legacy, and only in the next 5 to 10 years will we understand if the moves in the most significant budget for many a year will be beneficial to the country." And Roger Bootle writes in the Telegraph, very highly esteemed economist at Capital Economics, probably one of the best consultancies on economics in the UK, but he does write in the Telegraph, so slight pinch of salt. 3 key things he said. First, according to the national statistics, productivity in the public sector is 7% lower than it was in 2019. Nevertheless, the public sector pay is likely to be about £20 billion or 9% higher in 24-25 than it was expected to be alone 3 years ago. So lower productivity, a lot more money being thrown at it. Secondly, on benefits, expenditure has just doubled in real terms in the last 20 years. It is up by 20% alone since pre-pandemic of 1920. And lastly, the rate of economic inactivity has increased alarmingly. This is a horrendous statistic. The share of 16 to 64-year-olds not in the labour force, not able to work or not seeking work is 22%, just under 22%. So nearly 1 in 4 of those 16 to 24-year-olds who are the drivers of the economy are actually not working. And I think, dependent on where you are on the political landscape, the widespread worry is although many people support potentially a bigger state and the use of that money to help in the NHS, defence, education, is that money going to be spent well? And many a client just in the last week has given me their important information about changes to the winter fuel payment. Have you all had that letter? Look at that. Not all, but most by the sound of it. So that letter alone has gone to nearly 10 million pensioners apparently. A second-class stamp costs 85p. Don't need brains of an archbishop. It's about £8 to £9 million of cost to tell you that you've lost a winter fuel allowance. Now, I'll leave you to judge whether that's a good use of your tax-paying money as one simple example. And I think before we're going to have the quotes from the OBR, which are quite stark about the budget, but the sort of macro position is it is very much front-end loaded. So this extra investment, the extra borrowing that's coming in is being thrown into things in the first couple of years, and that may help growth a little bit. But thereafter, actually, there aren't much rise in spending in the last 3 years, and there's a great worry because of that this government may come back in a couple of years' time as we get nearer an election and do something else. And the growth that they talked about, growth, is not really forecast to come through in this 5 years. It's something that may come through as a result of a sort of infrastructure investment and so on in 5 or 10 years' time. And the bigger problem probably is that the private sector is in a headwind. So your average employer, as I said, with a £35,000 a year salary is spending 26% more just to keep that person employed. Employers' rights, which is Angela Rayner's big paper, whether you think it's right or wrong, it's going to be harder to move your employee costs around. And lastly, the minimum wage, as I remarked, has gone up. So there's a huge pressure on employers just to keep the same workforce. And you've heard all the interviews in the BBC and the ITV about what those businesses feel like. So there's a headwind in those businesses of higher costs. Are they going to invest for growth given that headwind? And the other fact that's come through loud and clear in the last couple of days is that the infrastructure and the big spending, the investment that's going to come through, and the extra costs that businesses are going to incur is inflationary in the near term. Although inflation is down, it's likely to start to come up. And that means that we don't think interest rates will fall quite as far or as quickly in the UK as had previously been thought. So let's be clear, next Thursday the Bank of England will announce its November interest rate decision. It was 100% of consensus it will go down. It's now gone to 90%. So everyone still feels base rates will be cut next Thursday from 5 to 4.75. But the consensus a year out was they will drop to 3.5 before the budget. That consensus for interest rate positions in a year's time is now 4. So still a fall, but not as much. And again, interest rates falling more slowly, interest rates staying higher, is viewed as bad for business, bad for investment, because the cost of borrowing remains higher. So all in all, the macro picture and the drive for growth there is a worry, and the headroom for if this goes wrong is very narrow. She's given herself, Harriet Harman, about £10 billion of headroom either way around. They think with the 10-year gilt yield going up to something like 4.5%, the cost of borrowing for the government goes up, and that headroom has shrunk. So we haven't finished yet, is I think the key remark. So what I'm going to do is put on, just for a couple of minutes, the OBR zone. He's a rather dull accountant-looking person, the head of the OBR, and he's going to tell you the key 5 takeaways from the budget.
We've just published our October 2024 Economic and Fiscal Outlook. Against a largely unchanged economic and fiscal backdrop, today's budget delivers a large, sustained increase in spending, tax and borrowing, a temporary boost to the economy, and a new set of fiscal rules. Here are 5 things you need to know. The new government's budget increases spending by £70 billion per year over the next 5 years. 2/3 of this goes on day-to-day spending, while 1/3 goes on investment. This means the size of the state as a share of the economy now settles at 44% by the end of the decade, 5 percentage points higher than before the pandemic. Just over half of this is funded by an increase in taxes, which raise £36 billion a year in extra revenue, most of which comes from an increase in employer national insurance contributions. These and other tax changes take the overall tax burden to 38% of GDP by the end of the decade, its highest level on record. The other half of the increase in spending is funded through extra borrowing, which means that total government borrowing falls more slowly and is around 1% of GDP, or £32 billion higher a year over the forecast. The extra government borrowing delivers a temporary boost to the economy, with real GDP growth rising from 1.1% this year to 2% next year. But budget policies leave the level of output largely unchanged in the final year of our forecast. To make room for this extra borrowing, the government also sets itself 2 new fiscal rules over the next 5 years. The first one is to balance the current budget, or the difference between day-to-day spending and revenues, which it meets by a margin of £10 billion. The second one is to get its net financial liabilities, or the difference between its debts and its financial assets, falling as a share of GDP, which it meets by a margin of £16 billion. And you can find out more in our October 2024 Economic and Fiscal Outlook.
I know you're all dying to find out more in the October version of that. And we've only got 5 questions for you, because there are only 5 points, because it's quite simple. No, we'll leave those questions for later. Right, so let's just very briefly look at the key under headlines, but actually this has not really changed a great deal, and I'm not going to overdwell on it. Personal allowance stays the same, 12,570. Key thing at the bottom, one nice thing, is they will be unfrozen in April 2028. Hold on, we've got a 5-year term for Parliament. We had an election in 24, election in 25. Oh, they've unfrozen them in 28. What does that mean? One interesting thing, we think the state pension is very likely to be virtually at this level in 2 tax years. So we could have in the current term of Parliament, if these remain unfrozen, as they say they will till 28, the fact that state pensions on the new version will be higher than the actual personal allowance means state pension holders are going to pay tax. How that's going to work, who knows? The thresholds remain the same, so basically you get to 50,270, you pay higher rate tax. Over 125,000, you pay 45%. Again, frozen to 28, unfrozen, and so unfrozen from 28. And of course, as these allowances stay the same, it's called fiscal drag. You get an increase in your pensions, you get a state pension going up, you've got more money above the threshold, you're paying more tax. So automatically, you will see your pay-as-you-earn coding on your main pensions take more money away from you as the state pension uses more of your personal allowance. In terms of the savings and dividends, unchanged, up to £1,000 if you're a basic rate taxpayer, fine, no tax. Up to £500 if you're a higher rate, and you don't have it if you're over 125,000. And with dividends, the same sort of principle, but the much lower figure of £500 before paying tax, and then different levels of tax to pay. So the key thing, and it's getting an increasing prominence in the press, is how do they know? How do they know how much interest I got? When are they going to tax me? I earn more than £1,000 of interest. I earn more than £500 of dividends. And if you think about it, if you've got a balance in a building society or bank of about 22,000 at 4.5% using the slightly lower rates of interest, that's £1,000. So reflect in your own world. If you've got in a taxable cash something about 25,000 or more, you're liable for tax. And what will happen, unless that interest is huge at over £10,000 a year, is it should come through. The banks and the building societies report to the HMRC, and they will tax you for your pay-as-you-earn coding, is the theory. And all that John and I repeat is when you get your coding notices in January, February, any doubts, any questions, just feed to us, and we'll try and estimate what that means is taken deducted from your pension in tax through PAYE, and we'll look at your interest. What you need to do is you need to have a record of what your interest was from banks and building societies in the year that ended April 24. So have that note to hand, and it's a very quick and easy sum to decide what you need to do. And there may well be a few of our clients looking like this lady. There may be some shocks because it's now 2 years since interest rates rose. Many people haven't paid tax for interest in excess of £1,000 on deposit, and therefore the day of reckoning perhaps is coming about much quicker. Okay, what else have we got coming? ISAs, thankfully, have been untouched. You could say negative was that they are not going to go up from the 20,000 and haven't done for already 5 or so years, but I think the positive is they're still open. A lot of rumours were that it would be closed, you wouldn't be able to put more money in, there was going to be a cap. They're still open, so you can continue legally to shelter wealth in them. The Great British ISA, announced by Jeremy Hunt in a fanfare to a consultation paper in March 2024, this early March, scrapped, not going ahead, which is an extra 5,000, and everything else remains the same. I can't state the value, particularly to ageing couples, where you can transfer the deceased ISA to their partner, to their spouse on the first death, and retain all that wealth in a tax-free environment, giving great flexibility going forward. The fact that you can still do your premium bonds, there are still lots of ways legally that you can, if it's appropriate, keep your money out of a taxman's hands. And what about pensions? Well, pensions at the moment remain pretty attractive. You get tax relief on them. If you die before 75, they're completely tax-free to the spouse that survives. There is no inheritance tax on them, but that's going to change. From April 27, this is a significant change for defined contribution pension pots. So firstly, if you are a member of a defined benefit scheme, a typical public sector scheme, or maybe a big blue chip old style scheme, then that's unaffected. But if you are in defined contributions where you've got a pot of wealth from April 27, that wealth on your death will be included in your estate. and it will be liable for inheritance tax. Now, there is already a pretty hefty, how many pages? Don't know how 28-page consultation document out on this. The very fact that it's not coming in until April 27 shows the complexity that's needed and the legislation that's going to be required. But it is going to change strategy. There is no doubt about it. Those people, and John and I were absolutely there, that were advised that really if your wealth's over £1 million and you're in retirement, you're going to pay inheritance tax. You need income in retirement. Take it from your taxable wealth first, bring that down, that will save inheritance tax. Leave your pension because it was tax-free, inheritance tax-free. That's now changed, or it will change. There's no need for panic. There's no need to rush. And this is legislation when effectively the last one in the marriage passes away. So who knows who will be in government at the time, and who knows what the legislation will be like. But it is an absolute game changer, and it will, as I mentioned earlier, raise significant amounts of additional tax and affect people's planning. So don't panic, but undoubtedly we've already had messages. Do talk to us pretty quickly about it. But don't be put off, and please don't put your children off putting money into pensions. Rather controversially, the very highest paying taxpayers can still get high rate tax relief. Mainly because they're politicians, or maybe not politicians, judges, police, consultants in the NHS. There's been a big thing that they should have taxed them or got rid of high rate relief, and they haven't. You can still put up to £60,000 in. You can fund children, you can fund grandchildren, and they are, by a country mile, the most appropriate way to increase wealth to then give income in retirement. That doesn't change at all. It's just what happens at the end. So please don't let that message get changed. And then capital gains tax. It was widely forecast that this level would increase. It was actually forecast probably to go higher, but there is quite a big academic study that says if you raise the tax too much, you actually lower the overall tax. And on capital gains tax, you only pay capital gains tax if you've chosen to sell something. So if you don't think that the current government will last more than 5 years, don't sell any major assets that are liable for capital gain. Cross your fingers, and then it should get easier. But it was the Tories that brought in the reduction in the annual exemption. That's got nothing to do with the Labour Party. And then it was, I'm sure I just pressed next there, aren't I? There is a button here that I've told everyone today not to press that says escape. I thought I just pressed next, but we'll calmly carry on. Was that me, or probably was? Yeah. So what that did say is, it's trying to not to be put off. Capital gains tax has gone up from 10% if you're a basic rate taxpayer to 18% if you are now post last night. It's gone up from 18% to 24%. So CGT has gone up. If you have a property, it was 18 and 24%. Sorry, a second property, it was 18 and 24%. Are we looking?
You've broken it.
Oh dear, oh dear. I'll leave you to work at it. You've got to still pay if you sell your second property within 60 days. So the big message on capital gains tax is it has got worse. It's immediately got worse because it's been enacted from the 30th of October. And do talk to us. We still feel that it's essential you utilise your CGT exemption of the $3,000 each. We do still feel you should turn taxable wealth into tax-free wealth in the ISA by selling down taxable and putting it in. But thereafter, decisions really need to be thought through, particularly capital gains tax is still wiped out on death. So why would someone in their 80s or 90s pay a big CGT bill to maybe release wealth, potentially to pass it on, and not survive 7 years? They could have 2 bites of a cherry. So just be careful with that. Starting to panic a little bit. Right, inheritance tax would be the next slide. So inheritance tax, the thresholds remain the same. They're 325,000. They've been like that since 910, and they're going to stay, and they are frozen for an extra 2 years, announced yesterday on Wednesday. So they're frozen till the 29-30 year, which is an extra 2 years. So the first 325,000 each, completely tax-free. If you are married and you have direct descendants, which means children or grandchildren, then you get another £175,000 as long as you own a property and either give your property on the death of the second to your children or direct descendants. And there are measures that if you've gone into, as an example, a nursing home, as long as you conceive as a succession at the house, sale into the wealth, and then down to the children, you still get the residence nil rate band. So the first...
Where are we?
Oh, there we go. Look at that. That's brilliant. We are...
You don't use the remote.
Oh, right.
Right, I'm back.
Okay, brilliant. Fantastic. Great job. That's brilliant. So we are back on stream. So the first £1 million, if you've got children and are a married couple with a property, is inheritance tax-free. No change in that. What they give, they take off. If you've got a large estate worth over £2 million, then every £2 above the 2 million, you lose £1 of the resident nil rate band. So that's the scene setting. No real change in that. We just put everything on a little bit further. But what has changed now? As I said earlier on, farms and businesses were completely exempt from inheritance tax. They got business property relief and agricultural property relief. They still, from April 26, will have the first £1 million exempt, but anything over that will only get 50% relief. So that a farm valued at 2 million would have passed down from the farmer to the farmer's son or the farmer's daughter. Now, when that 2 million farm passes down, they will somewhere, because it doesn't grow pounds and shillings, they will have to find £200,000. And the same with a business. So in a very illiquid business or a very illiquid farm, at the death of the survivor, will suddenly have to find hard cash to pay what is actually quite a small sum to the government. And I think it's quite interesting. Ed Balls has come out and said this could be something that runs, and has it really been thought through? £1 million sounds and is a lot of money, but at 10,000 an acre, which is a good price, that's only 100 acres. That's a very small farm. And even a hill farm, say at 5,000 acres, that's only £5,000 an acre for lower grade agricultural land. That's only 200 acres. So this is not big, massive estates, which the Secretary of State for Environment is sort of portraying it as, that it's only going to get the big farmer. Far from it. It will get most normal farms. And the fact of the matter is, with businesses, they don't have the liquidity necessarily to pay the inheritance tax bill. So where does it come from? So this is a significant move. AIM shares, you get 50% relief, having got complete relief, so that's another twist. If you sell a business as an entrepreneur, you get 10% tax on the first million. That's going up to 14 and then to 18%. And as we've said, pensions are changing. So quite a lot of change there, all of which is substantially going to hit estates. But it all adds to it feels very different. They're really having a go. And I'll return to this theme, but probably my gut feel and takeaway as I've met more and more people and we've reviewed and analysed is, in a way, the headline comes, nothing's changed, because when I look at your wealth and look at where your assets are, you can still give money away. You can still use, the various exemptions, the regular gifts out of income, the 3,000. You can give multi-millions and survive 7 years and not pay inheritance tax on it. You can still get at least £1 million on these business property relief schemes. You can obviously talk and get it sorted. So in a way, all of that's still there, but yet it does feel as though sort of Big Brother's coming down and they're having a go. The state is undoubtedly bigger. Big government is here. And is this just the start? Is it going to go on? There is more that can be done. And I think that the big message is what we've seen, John and I, in the run-up to the budget with all the sort of scare stories, was people crystallising their thoughts that, oh, I know I need to do something. And it was, I've got to do something now because it's going to get terrible. And I suspect what this may do is lead that on a little bit more, where those of you who can and should and feel they want to will probably get on and do things, because we're stuck in this regime certainly for 5 years. And if reform are around, splitting that Conservative vote, we're likely to see it for much longer. So a lot going on in that space. State pensions, the good news, I guess I should have put it there, the triple lock is maintained. Anyone of pension age will get the higher of whatever's going on. This year it is the wages inflation at 4.1. And as I said right at the beginning, if you multiply this out, we are getting very close in a couple of years to 12,570 for the newer state pension, which means that you're going to be in the basic rate tax band. So my positive points, or my not so positive points, just to start off with, because I don't like saying negative. Taxes at record levels. We are going to see everyone paying more tax because of fiscal drought, because the thresholds remain frozen. I've mentioned our worry that even though inflation looks really benign at the moment, you are going to be paying more, or seeing price rises go up. And I'm going to talk about inflation and demographics later. Higher levels of CGT, more catches in inheritance tax. And continuing that, the business property relief, the agricultural property relief, the employers' NI rise, borrowing rules change so that more borrowing as a statement of fact, government debt levels higher, interest rates the government's paying higher. We are in for a rather tough period of time, and maybe not the growth the government was hoping to come through. So where are we with what is positive? You can still shelter 20,000 per person, 40,000 in total per couple in ISAs. You can still put money in premium bonds. Did anyone win the million? It's the 1st of November. Have we got good winnings? A lot of my clients are now on the premium bond app. I don't know when that's renewed, or it tells people when they've won. Interest rates, we, at least at the moment, with base rates at 5, are higher than inflation, so you are making a real return. As I said, you decide when you make a capital gain. When you sell your second property, sell shares. So you are in charge of deciding about your capital gains tax. And you can still obviously do quite a lot with regard to inheritance tax. Now, what I think I'm going to do, John, I think I'm going to have a question session here. Is that all right? So John's here to help answer those questions. And I'm going to then do a quick summary, as we always do, thereafter. So any questions of any form, you can be as political as you want. You don't have to be, but any questions at all on the budget, its effects on you, or anything like that. Well, Malcolm, we've got Sarah is bringing. This is Sarah Davis, everyone. Many of you will have heard of her.
Richard, you didn't mention in the changes to the budget, so I don't think there are any, on the extra personal allowance you get if your earned income is below the 12,570. Extra 5,000.
Yep. So the personal interest allowance remains 1,000, but also the starting rate of tax on savings, which is what you're referring to, Malcolm, remains at 5,000. So everything that was there last year and this year, which is 12,570 tick, 1,000 personal interest tick, and that 5,000 tick all remain. Taking you, I think, to 18,570 before any tax. No, I had that in a slide, but I tried to cut some things out to do the macro bit a little bit more. Any other questions? We're all happy, aren't we? Oh, here we go. Yes, Joe.
Just a question about payment of inheritance tax. Does the allowance that you both get carry forward until the second one dies before you have to pay anything? And how does that affect transfer of an ISA and the valuation of the estate of the person that's died?
Right, so got the first bit. I may come back to you on the second one. So most married couples in their wills state that whoever dies first, most, which is your question, give everything to the spouse. And it was Alistair Darling in 2009 or 2010 that did the unused allowance rule, which means that I, as a husband, give to my wife all of the wealth, and I haven't used my 325 allowance, so she gets her own allowance still, because she's alive, and my unused allowance. So basically, on the death of the first, they transfer their allowance to the survivor. So the survivors straight away got 650. That answers your first question. In terms of assets, and I may be getting it slightly wrong, if you own a house, you own a joint account, you own a joint portfolio, they automatically revert to the survivor anyway, as long as it's joint tenancy. But if, for instance, your ISA, you have to wait for probate. And at that time, whether it's your ISA, whether it's a property in your name, whether it's a car in your name or whatever, grant of probate comes. That's the legal authority for the executors then to transfer the assets of the deceased into the name of the survivor. And one interesting extra thing which I'm adding to it is that what's really going to be confusing, because probate's not quick. We talk about the public sector productivity. It's not a good thing trying to get probate at the moment with the Capital Taxes Office. 12 to 16 weeks from the form going in. It is what will happen from April 27 if you've got a defined contribution pension pot. Your executors have to do all their normal work. They then have to liaise with the pension company to cross-refer and advise what inheritance tax is due on the pension, and the pension then will pay the inheritance tax directly to the government on what is owed. And John and I, Sarah's another good example, when we are spending time with a whole range of pension companies that are prehistoric and in their 80s in the way they communicate, I hate to think how much time will be wasted and slowed down with that process coming in from April 27. Maybe one more question? Yeah, Theo.
Thank you. A few years ago, as Chancellor of the Exchequer, I believe Gordon Brown removed a lot of the advantages of trusts, but you still have use of trusts as a means of ameliorating some of your inheritance tax. What is the current situation?
Yeah, the current situation is trust legislation, I think, hasn't been changed probably since Gordon Brown. So everyone in this audience today could set up a discretionary trust, gift into it £325,000 per person, pay no immediate inheritance tax, and if they survive 7 years, which as I said is unchanged, that wealth has left their estate. The taxation of discretionary trusts is you pay effectively income tax at the higher rate or the dividend tax at the higher rate, but the vehicles you use to house wealth in it can be clever, and we do a lot of that. And the only other thing I would say which is not trust, so trusts still work, but there's a limitation effectively on how much you can put in them, and they save a lot of inheritance tax. What I didn't mention with business property relief, there are still schemes from 6 different providers. There we go, Sarah. Triple Point, Octopus, Puma, to name 3 very quickly, who you can buy into the shares of their businesses, and as long as you own them for only 2 years and you haven't put more than £1 million in, you immediately get 20%. You immediately get 100% relief. After 2 years, yeah.
Thank you.
Any other questions? Okay. Brilliant. Yep, we'll carry on. So what I'm going to do is not try to recover what Luke said about the US election, but I've got some slightly different things to say about it. We'll talk about interest rates and particularly where they are and what you should be looking at. Demographics, I think, is hugely important for the understanding and your awareness of the impact it will have on you, and then a little bit of update on St James's Place and where we are. So what Luke said already, and this does replicate it, is effectively whoever wins the American budget history shows the markets do broadly the same thing. And actually, we're not too worried about who wins. We are worried about one particular case, and I'll explain it in a second. And also trying to predict the implications for subsectors in the US market, we find rather difficult. So our example going back to 2016 on the left, highlighted by red, is that when Trump came into power in 2016, he wanted to expand massively the US's own relationship with oil, the shale and everything, become less reliant on the Middle East. So everyone thought that oil and the oil energy sector and the stocks within it would do brilliantly between 2016 and 2020. And actually what happened was they went down during that period, even though Trump was in power. Biden then is elected in 2020. He's all for wind, for solar, for green energy. So everyone thought green energy and that sector would do brilliantly, and he was against fossil fuels and oil. What happened in the intervening 4 years to now? Oil massively outperformed clean energy. So the point, and that Luke said and that we bang on about, is diversification is absolutely key to your portfolio, and trying to second guess what you do with it just on politics can be very, very dangerous. So let's just touch, oh, I mustn't touch that, I must hide it. Let's just touch on what Luke said, and what's quite interesting is these swing states. So forget about the election. All you really need to do, I think it's Pennsylvania, Arizona, Georgia, and Wisconsin have predicted it right between 9 and 11 times of the last 13 as to who will be president. And particularly Pennsylvania, Arizona, Georgia, and Wisconsin both they voted in Trump in 16 and they voted Biden in 20, which is why they're all banging on about this fairly small state called Wisconsin and Pennsylvania further up in the northeast. So they are going to really determine what will happen, these swing states, but particularly, I think, those four. The big fear that we hear in the market is not Trump or Harris. It's if Trump wins, but the Republicans then win the Senate, about American presidents that introduced tariffs that had dramatic effects, and he's got a lot of history wrong, which is not probably a surprise to many of you. And he's talking about 60% tariffs on a lot of Chinese goods. He's talking about 20% tariffs on many European goods, which will be turned around by Europe and China. It shows what's happened to markets from when base rates started to fall over various periods of time in America, and generally markets move very well. Maybe this time we could see a difference because inflation would be rising, the rate that we talked about in the UK, for different reasons, and therefore base rates may not fall as much. And again, next week is full of news. Obviously, on the Wednesday, having had the election on the Tuesday, 5th, and then the Fed report on its base rate, and again, to go down, and the UK, again, probably a fall, but what is the impact of these sort of in the longer term? And as we said, we think interest rates, therefore, may not fall as much as some have said. It was one provider, I think Virgin today actually increased already its fixed rate mortgage going forward, which takes me to interest. So these are the current best buy rates of well-known brands. They will fall on the left almost suddenly. Premium bonds has already gone down from 4.4 to 4.15 for the draw pool. Income bonds and direct saver have dropped from 4 to 3.75. I say drop, they've announced it happens, I think, 22nd of November. But what's interesting to me when you look at those, and these are the current best buys on fixed rates, I think they look quite competitive. Even though I've said maybe rates won't fall as much, I've still said consensus is maybe around 4% in a year's time. And if you've locked into these sort of rates, you may be quite pleased. So I think it's more a case now, as we see interest rates moving down, to fix some of your cash. Be aware clearly that if it's fixed outside of ISAs, you can't get at it. It's locked away. That's the deal. If you fix in a cash ISA, you can get at it, but there's a 30-day interest penalty. So talk to John and I think we're going to see quite a bit of movement in interest rates, and it's important that you sort of review it. And unfortunately, despite AI and everything else, we all seem to get older most years. And we don't seem to be able to defy that, but worse still, over 3 time frames from 93, 23, 33, and then estimated to 53, wherever you are in a major part of the world, with the exception of Africa, the average age of a population, or the amount of a population over 65, is increasing. It's a simple fact. And you are going to live longer than your parents. A lady in 51 who was 65 would be expected to live to 80. That same lady in the current year would be expected to live to 90. So we are all getting older, clearly, but we're living longer. And what's relevant to that? Well, firstly, just let's say it's not the UK. The one I love here is South Korea at the top. I mean, they were having quite a few babies, averaging 5.95 in 1960. I don't quite know what they're doing. They must be watching too much telly or something, but something's changed, because their fertility rate now is way lower than anywhere else in the world. So I haven't been to South Korea. It'd be an interesting place to go. But by and large, it's very clear that whilst everyone is aging, there are less children coming in to the world. So the replacement rate, as it's called, is getting less. The engine room in the future. And how will that how will that affect you, and how will it affect inflation? So this is an old, I just about remember it, demand and supply graph. So supply of workers should decrease because there are going to be less people between 16 and 64. Actually, the workers should still create the engine room and indeed buy things, but there are less people buying those things, so maybe we'll end up with lower inflation. But this is a problem when you look at how things are consumed. As you go along the age graph, there's this thing called health. That people's knees, their hips, their cataracts, just about everything starts to cause a problem, and it costs money, whether it costs money to the state or whether it costs you to queue jump and go on. So when we factor that in, supply, i.e. the people to do the labour, the people to do the work, still falls, which is down from S1 to S2. But you could look at demand and say, even though there are less workers and therefore maybe less demand from the workers, actually the retired population, which is booming and growing, is also spending a shed load more money just trying to stay alive and keep fit. And therefore price goes up. It's inflationary. And more importantly, the thing you are likely to spend more money on for the rest of your life, called health in its roundest sense, or care, is going up by a damn sight more than inflation. So this matters. This matters because it means a lot of the retired population are scared about giving money away. They want dignity in retirement. They want to choose to go privately for the knee, the hip, the cataract. They want a gardener, if you can find a gardener. All of these things, and therefore there's a conflict between this new state wanting to get bigger and wanting to take more money away, but the retired getting huge in population, needing more resources, inflation on where they spend things, leading to higher costs. So a lot to take in there, a lot to take in, and we'll try to summarise in a minute. Coming lastly back to home, I'd spent the entire general review on St James's Place, which was dull and boring in March at Weatherby Racecourse. We've had a very good year, to be frank. This was our half-year results in the Times, chief executive, and our share price went up 25% on the day we released the figures, strong figures. Investors Chronicle just a week ago on the left from our third quarters, saying St James's Place powers through the quarter. So our gross figures have been extremely high. We will announce that we've got our millionth advised client by the end of the current year. The net figures of retention are extremely high, and we're grateful to you all, despite all the negative publicity that I referred to earlier, that the business is in rude health, and the demand generally outside St James's Place for people wanting help with their finances is just growing and growing, and the number of suppliers of intermediaries trying to give advice is actually sadly going down. And what we're so proud of, and actually I didn't thank them this morning, the girls who make sure John and I are on the straight and narrow and are your interface, Rebecca, Sarah, Catherine, Ruth and Claire, your own survey. We publish our survey every year. Not many other people do that. There's on our website a survey from 19. We didn't do one in 2021 or 22. And then 23 and 24 are there with, what for a consumer-facing organisation are staggering positive figures. And we are very sensitive of age discrimination, so we've tried to make things easier. You can now ring us if you wish to get some of your ISA money out, and we can instruct on the phone within the day. If you ring it in the morning, we can do it by lunchtime. And we still need written authorities on some of the other things, but we're trying to push that through. So we're trying to make it easier for you all to get the help that you need. So I think somehow we've managed to break a machine and resurrect it. What time are we on? We've got maybe 10 minutes if there are any other questions of any general sort. I realise it's Friday, it's a half term, and the Weatherby Road isn't the best. Any questions on any other aspect?
We didn't break the machine, you did.
A bad workman blames his tools, doesn't he, Chris? Absolutely. Great. Well, I won't do any further. What you do have, which I have to remember, is you have feedback sheets. Please, particularly if you want to review what the budget means for you before we do the next review, do tell us. We will get hold of you. We've got all of November and December. We've got created some time there to make sure that we look at things. And I sort of end as I started. Nothing has changed, but yet it seems everything has changed. It is a strange feeling because that budget, my goodness, I haven't seen something like that probably most of my career. And yet, when I look at it, and I look at my lens of advising you and John's into your wealth, it doesn't feel as though that much has changed. So don't panic, don't rush into things, but we know the direction of travel, shall we say, and possibly it is a time to take a full review of what you're doing. Lovely to see you. Happy Friday, happy November, and let's hope England beat the All Blacks tomorrow. All the best.